When the largest buyer quietly disappears, $850 billion. Not a headline, not a threat, and certainly not a conspiracy theory. It is a position that, for the past 20 years, has kept your interest rates low, kept your mortgage affordable, and kept the entire financial system running without anyone needing to ask questions. But the most frightening thing in finance is not when someone sells in panic. It is when they simply stop showing up. No announcement, no declaration of war, no warning from a central bank. Just an empty chair in the largest debt market in the world. And when that chair is empty, every number you once believed was stable begins to adjust on its own. Interest rates do not rise because of what the Fed says. Mortgages do not rise because inflation heats up. They rise because the largest buyer has stepped away. And the real question is not, will the bond market collapse? The question is, who will replace the buyer who has disappeared? Because if no one does, then the price of money will no longer be the same. And before we go any deeper, don't forget to press the subscribe button so you can continue accompanying the channel. This is not a conspiracy theory. This is market mechanics. Before going any further, we need to clear up a very dangerous misunderstanding. Number 8, $50 billion cannot bring down the United States overnight. The U.S. bond market is worth tens of trillions of dollars. It is deep, it is broad, and it does not collapse just because one participant sells. So why does this number make people inside the system uneasy? Because in the bond market, it is not the largest seller who determines everything. It is the marginal buyer. Who is the marginal buyer? The one who shows up when the market needs it most. The one willing to buy more when supply increases. The one who keeps yields from spiking when debt is issued en masse. For many years, China was exactly that buyer. They did not need to dump bonds. They did not need to create panic. Simply by no longer playing the role of buyer of last resort, the price of money begins to adjust on its own. And this is the point that many people miss. Markets are not afraid when someone sells. Markets are afraid when they do not know who will buy. This is not a collapse. This is repricing. A quiet process, without fanfare or alarms, but brutally unforgiving to those who still believe that everything will return to normal just because the Fed will save it. If you believe the Fed can control everything, you are looking in the wrong place. Because from here on, the story is no longer about monetary policy, but about the structure of global capital flows. And to understand why that completely changes the game, we have to go back to the 20-year arrangement that allowed this system to last as long as it did. The greatest financial trade in history, and its breaking point to understand why that empty chair matters so much. We have to return to the implicit arrangement that shaped the world for more than 2 decades. After China joined the WTO, a very specific cycle began to operate. China produced. The United States consumed. Cheap goods flowed into the U.S., electronics, clothing, household appliances, furniture. In return, the U.S. paid in dollars. But the key point was not that China received dollars. It was what they did with those dollars. They did not spend them on consumption. They did not use them for speculation. They recycled them straight back into the U.S. debt market. China bought U.S. Treasury bonds. They lent the United States back the very money the U.S. had just paid them. What was the result? The U.S. financed its lifestyle with cheap debt. Interest rates were kept at unusually low levels. The renminbi was held at a competitive level. American consumers were effectively subsidized. Without realizing it, this was not a conspiracy. It was a logical, mutually beneficial transaction. It was the most successful financial trade of modern history. But every trade exists only as long as the incentives exist. And then, those incentives disappeared. Trade wars, tariffs, technology sanctions, the weaponization of supply chains. When the U.S. imposed high tariffs and restricted access to technology, the message was very clear. Your dollars are no longer as welcome as before. And China responded in a very logical way. They did not declare war. They did not issue threats. They stopped recycling dollars into U.S. debt. From being the marginal buyer, they became a passive seller. No dumping, no shock. Simply, no longer playing the role of stabilizer. And when that loop was broken, an uncomfortable truth began to surface. The entire U.S. financial system had grown accustomed to a buyer who always showed up. Now that buyer has left the table, the question is no longer, what is China doing? The question is, Who will step in to finance a government that runs trillion-dollar deficits year after year? And to answer that question, we have to look directly at the deficit problem that the market has been trying to avoid. When the government needs lenders, but the lenders have left the table, the real problem is not China. It lies in the fiscal equation of the United States itself. At present, the U.S. government spends about $2 trillion more than it collects each year. This figure is not an exception. It is the new normal. What does that mean? Backhand index pointing right every year. Washington is forced to issue trillions of dollars in new bonds just to maintain current operations. Not to build anything new, not to expand production, just to pay old bills. In the past, this did not create tension, because there were always foreign buyers standing ready. China, Japan, sovereign reserve funds, they absorbed most of the newly issued debt. But now, the picture has changed. China no longer recycles dollars as before. Japan has to sell U.S. treasuries to defend the yen. And the Federal Reserve is tightening quantitatively. It is selling, not buying. So the question becomes very simple. Who will buy this massive amount of debt? The answer is domestic investors, banks, pension funds, the American public. But markets do not operate by command. They operate by price. If you want someone to lend you more money, you have to pay them more. And that is where everything begins to shift. When the supply of bonds increases and demand is no longer automatically absorbed, bond prices are forced to fall. And here is the most important rule you need to remember. In the bond market, prices and yields always move in opposite directions. Bond prices fall, yields rise. Not because inflation increases, not because the Fed makes a statement, but because buyers demand higher risk compensation to shoulder an ever-growing pile of debt. And from here, the impact no longer stays on the government's balance sheet. It flows straight into everyday life. Because long-term bond yields are the foundation for all other interest rates in the economy, especially mortgage rates. In the next part, we will see why the Fed no longer controls mortgage rates, why housing freezes even though demand still exists, and why this is the point at which the middle class suffers the greatest damage. Why the Fed no longer controls mortgage rates. This is where the story leaves Washington and goes straight into your home. Most people believe that if the Federal Reserve cuts interest rates, mortgage rates will fall as well. That sounds reasonable. But in reality, it does not work that way. The Fed controls only short-term interest rates, the overnight rates between banks. Long-term interest rates, especially the 30-year mortgage rate, are determined by the bond market. More specifically, the 30-year mortgage rate tracks very closely the yield on the 10-year U.S. Treasury. And that yield does not listen to Fed press conferences. It listens to the real supply and demand of capital flows. When the government issues more and more debt, and foreign buyers no longer absorb it as before, investors demand higher yields to continue lending. So what happens then? Bond prices fall, yields rise, and mortgage rates are forced to rise as well, even if inflation cools. Even if the Fed signals a pivot. This is something many people do not understand, and it is also why today's housing market feels frozen. Not because there are no people who want to buy homes, but because the price of money has changed. When mortgage rates rise from 3% to 6%, the monthly payment does not double. It increases by more than double. And when rates approach 7 to 8%, many middle-class families are pushed completely out of the market. The most worrying thing is not that home prices fall. Home prices can adjust. What is truly concerning is trust. They are the foundation of the entire credit system. And to understand why this is especially dangerous for banks, we need to look inside their balance sheets. When what was considered safe becomes a burden, to understand why rising interest rates are so dangerous, we need to look at how banks actually operate. Banks do not keep your money in a vault. They take those deposits and invest them in what are considered the safest assets. And for many decades, no asset was considered safer than U.S. government bonds. Banks bought long-term bonds with low, stable yields, believing they could hold them to maturity. The problem began to appear when interest rates rose faster than expected. When market interest rates rise, the prices of older bonds, with lower yields, fall immediately. This is not an opinion. This is mathematics. A bond paying 2% is no longer attractive when the market demands 5% or 6%. So what is the result? Banks are holding assets that, on paper, have lost hundreds of billions of dollars in value. But there is an important detail. As long as banks do not sell those bonds, they do not have to recognize the losses. On the books, everything still looks fine. The system continues to operate until depositors lose confidence. When you withdraw money from a bank, the bank has to pay you in cash. To get cash, they are forced to sell bonds. And when they sell at prices far below what they paid, those unrealized losses become real losses. This is exactly what happened with Silicon Valley Bank. And that was not an isolated case. Right now, many U.S. banks are sitting on massive unrealized losses because they bought bonds during the low-rate era. As interest rates continue to be pushed higher by pressure from the bond market, those unrealized losses grow even larger. The issue is not whether banks committed fraud. The issue is this: the system was designed for a world of prolonged low interest rates, and that world no longer exists. A small shock to confidence can force banks to realize those losses. And when that happens on a broad scale, it is no longer the story of one bank, but the story of the entire system. But the real risk does not come only from bank balance sheets. It comes from the fact that the system's final safety buffer has been depleted. To understand that, we need to look at a mechanism few people talk about, yet one that is extremely important: the reverse repo facility. The world is not breaking, it is being repriced at this point. It is very easy to fall into a mistaken conclusion. When seeing interest rates rising, banks under pressure, bonds losing value, housing freezing, many people will think the system is collapsing. But in reality, that is not entirely the case. What we are witnessing is not the collapse of the global financial system, but its repricing. For more than 40 years, the world has operated in a very specific environment. Cheap money, prolonged low interest rates, maximum globalization, near frictionless cross-border capital flows. That period was an exception in history, not a natural state. Now, that exception is coming to an end. Central banks are beginning to behave differently. Countries are starting to prioritize security over efficiency. Supply chains are being designed to avoid disruption, rather than to be the cheapest possible. And when the world shifts from cheap capital to secure capital, the price of money is forced to rise. This explains why central banks are buying more gold. Energy trade is gradually accepting multiple currencies. Companies are shortening supply chains, even at higher cost, not because they are panicking, but because they are adapting. Repricing always comes with pain, because it forces us to acknowledge that old assumptions are no longer valid. But repricing is fundamentally different from collapse. The system does not disappear. It simply becomes more expensive, more disciplined, and less forgiving. The problem is that many households, businesses, and even governments were built on the old assumptions. And when the price of money changes, those structures begin to shake. What matters now is not panic, but recognizing that the rules of the game have changed. And to avoid misunderstanding what is happening, we need to clarify one more thing. Staying clear-headed matters more than predicting correctly. At this stage of the story, many people begin to go too far. They hear about bonds losing value, interest rates staying high for longer, banks under pressure, globalization reversing, and then they conclude, this is the end of the dollar. The system is about to collapse. Everything will go back to zero. But that is not what the data is saying. We need to be clear about three things. First, this is not the death of the US dollar. The dollar remains the currency that is the most liquid, the most widely used in global trade, and the foundation of the current financial system. That role does not disappear just because of a few years of stress. But, and this is the crucial point, that privilege is no longer free. Second, this is not an inevitable hyperinflation scenario. Inflation may remain higher for a period of time, but there is no evidence that an uncontrolled spiral like Weimar Germany or Venezuela is unavoidable. Those cases occurred when productive capacity collapsed entirely and trust in the state evaporated. That is not the current context of the United States. Third, this is also not a preordained Great Depression. Today's system has more policy tools, more oversight mechanisms, and more flexible intervention capacity, what is happening is not an overnight collapse, but a prolonged adjustment phase. The biggest problem right now is not that the market is too dangerous. It is that investors are still acting based on old assumptions. They believe that bonds are always a safe haven. The Fed can always save the market. High interest rates are only temporary. Those beliefs were built in a world of cheap money, and that world no longer exists. The right question at this moment is not, when will everything collapse? But rather, what kind of world is my portfolio built for? A world of zero interest rates? Or a world where money has a price and risk is no longer hidden? In the final part, we will not talk about fear, but about the right way to think in this new context. Not to escape the system, but to understand the rules by which it is now operating. Don't look at predictions. Look at signals. If you look back at everything we've just gone through, you'll realize one very important thing. There was no moment here when the system suddenly went crazy. There was no explosion, no doomsday event, only small signals, appearing in places most people don't pay attention to. A major buyer no longer showing up consistently. A market beginning to demand a higher price for the same debt. A liquidity mechanism that once absorbed every shock now running dry. The bond market doesn't scream. It whispers. And when it whispers, those who are used to following headlines won't notice anything at all. But those who understand the mechanics will know that the rules of the game are changing. Not because someone wants them to, but because mathematics forces them to. The most important takeaway from this video is not a specific prediction. Not how high interest rates will go, how much housing prices will fall, or when a crisis will happen, but this question: which decade's assumptions are you building your financial decisions on? If they are still cheap money forever, bonds are always safe. And has just sent its most notable signal in many years. Click on the next video to understand what the Fed is actually worried about and why the bond market always knows first. We don't need to panic, but we do need to stay clear-headed. And clarity always begins with looking in the right place. And before ending this video, I'd like you to subscribe to the channel because many valuable insights are still waiting for you to discover. Thank you sincerely for watching.